Okay, let's unpack this. Today, we are diving deep into the recent financial results and strategic maneuvers of LT Foods, the global FMCG giant behind those specialty rice powerhouse brands Daawat and Royal.
That's right. Our mission today is really to move past the glossy headlines. We need to understand the price of their ambition, you could say. They just closed out the first half of fiscal year 26. And yeah, the growth looks stellar on the surface, but we need to analyze the strategic trade-offs, how they're funding these massive global acquisitions and geographical leaps, while at the same time grappling with some serious issues, things like trade disputes and, well, unavoidable short-term margin decay.
The headlines certainly are eye-catching. For the first half of FY26, consolidated revenue surged 25% year over year. That's 5,273 crores. And EBITDA grew 20% to 619 crores. I mean, those are phenomenal numbers.
They are, absolutely. But management was careful to provide a normalized growth figure, too, around 15%, which is important because when you take out the noise, specifically the consolidation of their North American business, Golden Star, and maybe the initial impact of U.S. tariffs, 15%, is still robust, definitely. But it gives us clarity. It sort of tells us the underlying organic growth engine is strong. And, over the long game, they've been fiercely consistent. They've clocked a 5-year revenue CGR of 16%.
Okay, so if the revenue growth is so strong, why are we seeing this simultaneous drop in profitability? That seems to be the core question here. In H1, the EBITDA margin dipped by 40 basis points down to 11.7%, and the net profit margin dropped almost a full percentage point. What's driving that?
Right, and this is where the strategy really comes into play. Management is quite transparent that this margin squeeze is deliberate. They are aggressively increasing expenditure on brand building, strategic initiatives, pushing for digital transformation. Essentially, they're buying future market share and capability today, and that means sacrificing some current profitability percentages.
So they're basically saying, look, we're not failing operationally, we're investing heavily for the long run. But isn't there a risk the market just sees the margin decay and kind of misses that long-term investment story?
Absolutely. It introduces execution risk, no doubt. However, you have to look at their efficiency metrics to see if the underlying business is, crumbling. And it's not. Actually, quite the opposite. Their core operational efficiency metrics dramatically improved.
Yeah, this is where it gets really interesting, I thought. While the profit margins went down, their return on capital employed, the ROCE, actually improved. It's up to 22%. And their balance sheet health looks way stronger. Their net debt to EBITDA ratio dropped sharply from 0.79 down to 0.46.
That's a massive improvement in financial flexibility, right?
Yeah.
It tells us that despite the aggressive spending we see on the income statement, the company is actually generating cash faster and managing its debt better. And furthermore, they got more efficient at cash conversion. They reduced their working capital days from 195 down to 174. That's nearly 3 weeks faster they are turning inventory and receivables into actual cash.
Okay, now this leads us to a fascinating point revealed in the sources, kind of a paradox, the cash dichotomy. They report having this large pool of cash, over 61,000 lakhs, which is, hundreds of millions of rupees, yet they also carry substantial short-term borrowings. Why? Why keep so much cash on hand if you also have debt?
Well, this is purely a function of running a massive multinational FMCG operation like theirs. They explained that their India division is often cash surplus, especially as they gear up for the essential procurement season, right? And they are earning a return on that liquidity. However, their international subsidiaries, many of which are newer or recently acquired, they need working capital loans locally. And due to regulatory hurdles, operational complexities, you can't just shift cash seamlessly across global borders all the time. So it results in this kind of split balance sheet picture.
Right, that makes sense. And that flexibility, that cash generation, is precisely what allows them to fund these two huge strategic moves they've made recently, specifically cementing their position in Europe and North America.
It's exactly. Let's start with Europe. This represents a major strategic diversification for them. They acquired Hungary-based Global Green KFT. The deal was worth about $25 million, and this is expected to add a solid $40 million in revenue annually. But the real significance isn't just the number, it's the pivot. This establishes their third manufacturing hub globally, gives them immediate, deeper penetration into Central and Southern Europe. And maybe more importantly, it marks their strategic entry into the huge 15 billion European processed canned food market. It's moving them beyond their traditional dominance in specialty rice.
So they are using their rice money, essentially, to jump into new related products globally.
Okay.
Meanwhile, across the Atlantic, they completely sealed their dominance in North American specialty rice, didn't they?
That's right. They finalized the full acquisition of Golden Star Trading Inc., or GS. They bought the remaining 49% stake they didn't own for $15 million. This also resulted in a beneficial accounting change. It gave them a one-time payable profit of about 562 lakhs, which is over $6 million. But strategically, this is genius. Their flagship brand, Royal, is already the dominant basmati rice brand in the U.S. Golden Star is the #1 jasmine rice brand. So now they basically own the entire premium specialty rice aisle in North America.
And looking at the H1 revenue mix, the impact is immediately apparent, isn't it? North America now accounts for 46% of their total revenue and showed that huge unnormalized growth, 47% year over year.
Yeah, huge numbers. And within that, Royal holds a dominant 60% plus share of the basmati rice import market. Just massive. India, their home turf, makes up 30% of revenue, growing at a healthy 13% year over year. Daawat holds a very respectable 26.1% market share there, and critically, its household reach grew significantly. It's reaching over 56 lakh homes now, up from about 45 lakh a couple of years ago. And the star performer really, aside from the acquired growth in the U.S., was Europe and the U.K. That accounts for 15% of revenue and saw strong 31% year-over-year growth.
Clearly, that massive core specialty rice business is the engine funding this whole global expansion. Speaking of the core, the crop outlook is always essential for stability, right? What's the word on basmati production?
It looks stable, which is good news for predictability. Production is estimated to be slightly up, maybe 1.5%, around 18 million tons overall. And this stability is expected to keep input prices pretty stable year over year. So at least for their core raw material, they aren't anticipating massive volatility in the short term, which helps.
Okay, good. Let's pivot then to some of the maybe operational puzzles or challenges, particularly the organic segment. This segment grew revenue 26% in H1, which sounds fantastic, but the EBITDA margin just cratered. It dropped from 12% down to just 7%. What went wrong there, with demand or execution?
It seems mostly execution related to a strategic investment. They faced higher initial costs, primarily because they were commissioning a new B2C facility in Rotterdam, in Europe. And during this complex transition period, they had to temporarily rely on higher-cost third-party manufacturers. That squeezed the margin immediately. And second, yeah, they did face some global pressure on non-basmati organic rice prices. This was due to external factors like, crop production elsewhere and various global export bans impacting prices.
So classic short-term pain for long-term gain situation.
Precisely. That's how they view it. It's seen as temporary. Once that new Rotterdam facility is fully up and running, it's projected to really accelerate revenue. They're targeting something like 400 crores in incremental revenue just from that facility over the next 5 years.
Okay. And what about the smallest segment, ready to heat and ready to cook? That actually saw a revenue decline of 5%. What happened there?
Yeah, that decline was driven by a couple of things. One, an internal product decision. They discontinued the Daawat Sihat product line. But crucially, their capacity in the U.S. was constrained. They had delayed commissioning a second manufacturing unit there. So the underlying demand for convenient food is clearly there, yeah, but they are sort of playing catch-up on their ability to actually produce enough of it in the U.S. right now.
Right. Beyond these internal capacity constraints, the company is facing this absolutely huge regulatory headwind in the U.S. market regarding countervailing duties. Tell us about that.
Yeah, this is a major concern, potentially. It involves EcoPure Specialities, which is a subsidiary exporting organic soybean products to the U.S. The U.S. Department of Commerce imposed a preliminary countervailing duty, or CVD, of, get this, 340.27% on exports from the 2023 period.
Wait, 340%? That is an unbelievable figure. That's essentially a death penalty rate for those exports, right? It signals how serious this trade dispute is.
It really speaks to the complexity and sometimes the severity of international trade law. This extremely punitive rate was based on what's called an adverse facts available methodology. The final determination has actually been pushed back now until November 17, 2025. So there's time. And management asserts they have a very strong legal position to fight this. But in the meantime, yeah, that massive potential liability is kind of hanging over them.
And related to U.S. trade, what's the status of just passing on the existing tariffs, which total 50%, I believe, to their customers.
Ah, yes, that's the ongoing uphill battle, isn't it?
Yeah.
And it directly feeds into the margin pressure we talked about earlier. They apparently managed to partly pass on the initial 10% duty to customers, but the remaining 35%, well, that's still under negotiation. And until they can fully transfer that cost, it will continue to eat into their profitability in the North American market.
Okay. So as we look ahead, wrapping things up a bit, what is the clear target for LT Foods? What's the final destination for this aggressive strategy?
Their stated long-term goal, the big target, is to achieve an EBITDA margin of over 14% within the next 4 years. So getting back those margins and then some. They plan to hit this through a few levers. Aggressive premiumization of their products, leveraging their extensive distribution network. They have over 1,400 distributors just in India, and driving significant digital transformation efforts. They're aiming for that to basically double their business value eventually. The core strategy, though, remains pretty disciplined. Expand their powerful brands, Daawat and Royal, into adjacencies where they feel they have a clear right to win.
Okay, so to sum up this deep dive, LT Foods seems to be executing this powerful narrative, really balancing core strength with global aggression. They're clearly leveraging their dominant basmati business Daawat and Royal to fund these high-growth, maybe higher-risk expansions into new categories like European canned foods and cementing market control over U.S. jasmine rice with Golden Star. And while this strategy is causing some definite short-term margin pain due to heavy investment and these unavoidable trade hurdles, the underlying efficiency of the core business seems to be improving. It's a classic high-stakes trade-off, isn't it? Prioritizing long-term market dominance over immediate quarterly profit optimization.
Exactly. That narrative of paying the cost for dominance is precisely what the numbers reflect when you dig into them.
Yeah.
But let's maybe leave you, the listener, with one final thought. Something revealed deep in the financial notes that just reminds us how long corporate financial battles can actually run. It's about a historical litigation case involving an old insurance claim.
Oh, you mean the fire. The one at Daawat Foods from, wow, almost a decade ago now.
Exactly that one. The complex, decade-long insurance claim battle stemming from the 2014-2015 fire. Now, while the High Court appeal is apparently still pending, the company successfully received a massive deposit. We're talking 26,503.50 lakhs. That includes interest back in April 2025. This enormous sum is currently accounted for just as a liability on their balance sheet, pending the final legal decision, you see. But it really highlights that these long-tail financial issues, even from something like a fire that happened 10 years ago, can suddenly result in massive financial movements today. It's a remarkable piece of corporate history to track, really. And the final outcome of that long-running case, well, it will certainly be worth following.